In this video, I would like to do a very short recap on what we discussed in the course, but more specifically, I would like to do a recap on the standard strategy and then to point what add-ons and modifications you can do to it. So first, this is the standard strategy that you learned in this course. So I'm going to do here a recap, but you'll have to go on the original videos where are the buy entry signal, the stop loss positioning, and other signals to see the details and the crude depiction and the charts. So the entry signal, it's provided by a 20 period moving average. This is a simple moving average that you find on any charting platform with a period of 20. This means 20 days. The entry conditions are after price has traded and closed below the moving average 20. So you are going to see that in hindsight that the price is below. We wait for it to reverse and trade up again towards the moving average. We enter with a buy order after price has crossed above the moving average. So when you see that price crosses above that moving average, you get ready. You don't enter yet, but you get ready with all the calculations for a buy signal because the candlestick has to be closed. So this means that the market has to be closed. And if you want to enter when the market is closed, you need to add a pending buy order that is going to be positioned 1, 5 or 10 points above the candlestick. And those 1, 5, 10 points, they depend on the asset that you are using. So I discussed before about this. If you enter the next day when the market is open, then you are probably going to have like a slippage or a gap. And that's not a big problem. You just have to take that in calculations when you do your back testing and you calculate the potential profits. Or if you enter before the market closes, like 5 minutes before, you need to be very careful that that price doesn't cross below the moving average again, because it can do that. But you can see that in back testing how often it does that and how far away is it from the moving average to take this decision. And also if you do it, you need to, for all those 5 minutes until the market closes, you need to be in front of your screen watching that, because you can take a loss if you do that. So you need to be, this is not the best technique, but you can do it if you're in front of the screen all time, all those 5 minutes. Stop loss positioning will be 1, 5, 10 points under the candle used for entry. Take profit is going to be done with the REX indicator. So when the main line of the indicator, the default blue, crosses down the signal line, the default light brown color, and the conditions are market has to be closed, candle has to be closed, and line has to be crossed after the market and candle it's closed. Because sometimes it can just cross and until the market closes, it just crosses up again. So that's not a take profit signal. Next, rules you can add to protect profits and lower risk. We discussed this in some of the videos. You can move the stop loss 1, 5, 10 points under the moving average 20 every trading day. So I showed this in a few videos. Or you can move the stop loss under specific candles when the price is above the moving average 20 to protect profits. So when your trade is in profits, you can start to move your stop loss up above the entry price. So in this case, you secure some profits, but you need to choose very wisely where you move it, because the market can come down, take you out and continue to go up, and you're going to not like that. So this can be tricky. It's hard for me to tell you an exact rule for this. You're gonna have to see this in your back testing, and if you don't see it, just don't do it. It's simple. It's better if you don't do it, if you don't see it. And some ideas are when after an impulsive run up, so let's say you enter a trade and you have two candles that just run up, big long candles, and then the market creates a bearish candle. This would be like the trade the third day. So that could be a signal that the run is over. But you really need to see this in backtesting. You're going to observe this, that the price from the low to the high just created a long leg and the move might be over or not. And when after an impulsive run up with big low candles, the market creates a bearish candle with a long wick above. So you're going to see that and a small bearish body. This means rejection of higher prices and the market can reverse and go down. So again, you might want to see this in backtesting when you have that rejection of price what does it happen? Does the price go down and the Rex indicator would take you out, or it continues higher most of the times? So those are just very specific things that you might find that it gives you an edge on some assets, but it's pretty advanced. So if you don't see it, just don't use it, because as you see here with red, those ideas will not always work. Price can continue up after those kind of candles, after it takes you out of the market. And you should implement this kind of idea only after serious backtesting and data collecting about that asset. If the idea does not work on past data, it will probably not work on future data. So if you don't test and backtest, do not use it. In the backtesting videos and some other videos, I'm showing you live on charts those kind of ideas. I'm showing you that you can move your stop loss here or here if you see this kind of stuff. So that's just a specific idea on, it's just one case that I'm showing it there. So this doesn't mean it's going to work all the time. It's like, it's some kind of cherry picking, if you want to put it like that. So you might want to mark on your journal the video and the exact minute I'm talking about something. That can be an idea, so you can go back over it when you see it. Next, rules you can add to increase profit potential. So instead of positioning the stop loss under the entry candle as in the standard strategy, you can position it under the middle of the body of the entry candle, 1, 5, 10 points. So we did a whole video about this. And to find out the middle of the body of the candle, you can use the fib tool like shown in the video, or calculate it by numbers. And that's simple. You just subtract the open price from the close price and divide by 2. So obviously that's a bullish candle because the close price is going to be higher than the open price. So the difference between those, you split it in 2, and that's the middle of the body of the candle. So you put your stop loss there, and if you enter with a higher stop loss, that will increase the potential profits a lot. And again, this idea will not work on all assets, as we seen also in backtesting. You need to backtest this on each asset before you implement it in the strategy. So you might have one asset where this idea works very well, but you might have another asset where this idea does not work. So you'll just have, on an asset, you'll use the standard strategy with this modification on the stop loss positioning. So this is the type of things that you'll have to do. You'll have different rules for different assets. This is how trading works. So this would be the technical part of it. Remember, always go to the standard strategy if you think all the other things are confusing or you don't want to do it. You see that the standard strategy just works. I just give you the other ideas because, if you like this and you have time and you like to backtest, you can play around and you'll find many other things. Remember, this is a skill that you will develop it with backtesting and trading. Next, remember to recycle the risk so you can have multiple trades. So once you manage to move the stop loss to the entry point, which is the break-even point, you can open another trade on a different asset if you have a signal using the same risk. And for this, it's better to rewatch the video for more details because I'm showing you there visually a lot of details. And next we have the trading psychology, and this is just a very short recap about those videos and what to remember from trading psychology. So first, the skill of trading. Trading is a skill you can develop over time. The power of consistency. This will bring you profits, not the trades or the strategy. The power of compounding. This will grow your account, not the trades or the strategy. How to trust your system. Just do this. The reticular activating system. Use this tool inside your brain. The information bias. Be aware of this one. The best path to mastery. Remember that all shortcuts lead to the same path to mastery. So don't take any shortcuts. It's easier. The benefit of hindsight. Use it in your own advantage and not against you. Curve fitting. Just don't do it. Cherry picking. Don't fall in love with it. The uncertainty principle. Be aware of it. The confirmation bias. Don't fall for it. And journaling. Do it or probably fail. Journaling is the most important routine you need to have as a trader. This is where you journal your trades. You can write things down by hand. The reasons why you take a trade, the reasons why you take profits, including the mistakes that you did, the trades where you didn't respect your system, and it doesn't matter if that trade was a winner or a loser. If you have a winning trade and you didn't respect your system, that's not good. And just write it down so you don't repeat it again. And just write those things down in a very boring way, technical. So don't write emotional stuff like, I don't know, I did this, I shouldn't do this, or stuff like that. So this is not an emotional journal, it's just technical. So you can go back and read those. And if you want, every week or every 2 weeks, you can just revisit the things that you did in the last week or 2 weeks on that journal. Just see them, and you will, if you do this all the time, if it's every day or every 2-3 days, it depends how many trades you have. If you do this, I'll promise you that in months you'll be a different trader, you'll be a different person, and you'll learn a lot of things. And even if you don't do trading yet because you build your system and your backtesting, it's the same thing. Just journal your backtesting. It's very simple. You take all those trades that you backtest and you put them like I'm showing you in the journaling video. I will consider this video to be a conclusion video, like the last video from the course. But this doesn't mean I will not post other videos in the future. If I get an idea and I think this is good to put it here, I will probably add another video, or I will probably add another backtesting video from a different asset. And what I want to do is to find other assets and backtest them, even for me, and I will record that and add it here in the course. If I add a new video, I will just use the newsletter system from Udemy to let you know with an email or a message or something like that. So this is it. I hope you enjoyed this course. I hope you learned something new and useful. Until we discuss again, I want to wish you success in your trading and good luck.